The September quarter was a strong quarter for the REIT sector, and in particular the SGH Property Income Fund, which delivered a return of around 18% net to our investors. The macro environment was quite positive for the REIT sector. We saw bonds rally a little bit over the course of the quarter, while at the end of the quarter we saw the US Reserve begin its interest rate reductions with a 50 basis point cut. We also had reporting season over the quarter. FY24 results came in aggregate in line with our expectations, while FY25 guidance was a little bit below our expectations, not by much, and that was driven by some asset sales dilution and a little bit higher interest rate expense. In terms of contributors to our portfolio, we had strong contributors from Stockland, Vicinity Centres and GPT Group, while we actually only had one detractor, that being Australian REIT Office Fund. In terms of the SGH Property Income Fund, firstly, it's about investing in real assets, real property, for income at attractive valuations. We have seen a strong rally. Notwithstanding that rally, the portfolio is still trading at a discount to its net tangible asset backing at the end of the quarter of around 8%, and a discount to its net asset value, that's our net asset value, or as we refer to as NAV, of around 12%. In terms of its positioning, we have a good weighting towards convenience retail. We see that as attractively priced and very defensive. We continue to like the large destinational malls and we have a good weighting there. Having said that, there are a number of the larger REITs in that space and we have been reducing our position somewhat. We've been increasing our weighting towards the office REITs over the course of the last 6 months or so, because in the REIT sector at least, we see that as bottoming out and very deep value and a good source of income yield. What we're also seeing is we're seeing, as you would imagine in a rally, it tends to flow through into the larger REITs first. And our view is that that's left behind the smaller REITs where there's more value, and we see the market broadening out over time. So we've been taking some profits in the larger REITs and cycling them down into some of the smaller holdings. Well, interestingly, we continued on with what we were doing in the prior quarter. That is, we were selling down our weighting in Stockland, Scentre Group, both very good quality groups, but they've had a strong rally and we're starting to see value in other names. We increased our weighting to GPT Group. We continued with that into this quarter, as well as Charter Hall Social Infrastructure, and we actually exited Ingenia Communities. Well, firstly, the portfolio has had a strong performance in the last 12 months. I mean, going back over 12 months, we had interest rates on the ascent. And now at the, if you like, at the cups, and certainly started in Europe and in the US, of rates coming down. So more of a tailwind, and that's positive for REITs. We're seeing the top line income growth for the REIT sector has been quite positive. We saw that through reporting season. In fact, it actually accelerated. We're seeing the growth outlook for REITs looking better than financials. And as an example, the multiple still looks quite reasonable. So we think that overall, the outlook in the medium term for our portfolio looks quite favourable. Look, a metric that I would be closely looking at would be inflation bonds. Currently, the yield is around that 160 to 170 basis points, which is quite high, certainly quite high to where it's been over the last 10 years. Now, if that was to rally down, I see that that would provide the opportunity for the REIT sector's multiples to further expand, providing upwards growth profile.